Hey folks, welcome back to the channel. Let's talk about leverage today. Some of you may have seen or heard of the Yale study where some professors suggest that investors should use leverage in order to diversify across time and get higher returns. The result says that if you use leverage and everything else like market returns and savings rates are all the same, then you should be able to retire 6 years earlier. And they've tested the theory outside of the US and it seems to work for other countries as well, at least from the historical data. Part of the reason is because on average, the returns of the stock market, about 9%, has been higher than the cost to borrow money, which is about 5%. So that difference, or the 4% spread between the two over a long period of time, will give you some extra gains. And the other advantage of borrowing money to invest when you're younger comes from reducing risk through diversification across time. So that's why this paper claims that people can retire with substantially larger and safer retirement accumulations without having to save more. And all they have to do is just use leverage to invest while they're still young. But that being said, there are ways that you can really mess up using leverage, of course. So in this video, I want to share how to sustainably use leverage, and I'll use my own portfolio as an example. So even if the market drops another 20 or 30% from here, my investments are still going to be okay. I'm not going to sell. And I'm going to find ways to buy more stocks at a cheaper discount without risking getting a margin call or running into any liquidity problems. Now, using leverage is much easier if you own your own home, and I'm going to explain why that is. But first, just so we're all on the same page, when I say leverage, I simply mean using other people's money to invest. So the basic idea is if you invest $100 of your own money and that investment goes up 10%, then you've made $10 or a 10% return on your investment. But if you're able to double your investment by borrowing another $100, then you have $200 to invest. And if that's the case, then a 10% return on the actual investment will give you $20 because after you pay back the $100 loan, you're left with the profit of 20. So with a 2 times leverage, you can expect 2 times return on any gains and also 2 times negative returns on any investment that goes against your position. And how this works in margin accounts is the broker can actually lend you money to help you buy some shares. I use Interactive Brokers, so I will use this platform as an example, but pretty much they all work the same way. In most cases, if you're dealing with larger cap companies, the maximum amount IB will lend you is 70% of the value of the stock. So I'll use Apple as an example. This is a large cap stock, and let's say I want to buy 100 shares of it. I'm going to put in this trade order, but I'm not going to confirm it. So if I hit submit, this opens up the confirmation window, and you can see the amount of money it'll take to buy 100 shares is 13,444 because the stock is trading at 134 right now. So you just times that by 100. But this is not how much money I need to have in my account, because if I look over to the right here, the initial margin, which is how much excess capital or just excess cash I have in my account in order to make this trade, is actually this amount, 5,526, which in this case is the same as the maintenance margin. So the initial margin is how much money I need to place this trade now, and the maintenance margin is how much liquidity I need to have in my account on an ongoing basis in order for this position to hold and not be liquidated. So often they're the same, but sometimes these two could be different because there are different rules that affect the initial and the maintenance margin separately. So Apple is a large cap stock, and like I mentioned, for most of these companies, IB will lend you up to 70% of the value of the stock. So we can see how IB came up with this number here, like how much I need to have in order to make this trade. So the total capital needed to buy 100 shares is 13,444, and IB is willing to lend me 70%, which means I have to put up at least 30% of my own money. So if I multiply this total amount that is needed to purchase the 100 shares by 0.3, I have to come up with $4,033. This is in US dollars, and my base currency for Interactive Brokers is in Canadian dollars. So right now the currency exchange is about 1.37. So if I multiply this US dollars by 1.37, that's going to give me the Canadian dollar amount, which is roughly what this initial margin here is. So that's how we get to this number. So if you ever wonder, like, do you have enough money to purchase the stocks you want using margin, you can just look at this order confirmation form and make sure that you do have enough before you put in the trade, or just do the calculations yourself like I just showed. Now for other companies, the margin requirement will be different. So in this case, I only need 30% of my own capital in order to buy this stock. But for small or medium cap stocks, even some larger cap stocks, the rules are different. I have to maybe put up like 40% or 50% of the money. So it's nice to be aware of those things and just double check before you put in the trade. And you can either use the trading platform directly, like I've done here, but there's also a list of stocks that you can look at with different margin requirements. Now, using margin can be kind of tricky because if you don't have enough excess liquidity, then you could run into a major problem, which is getting forced liquidated. In my account, for example, you can see right now I have a net liquidity of 335. So if I were to sell everything right now, this is how much I would have in my account. And my maintenance margin is at 225. So I need to make sure that there is at least this much in my account. And the excess liquidity, or how much money I have now to invest more into the market, is this number right here, 112.8 thousand. Now, the net liquidity minus the maintenance margin pretty much gives me this. So I have to make sure that these two numbers are fairly far apart, because if let's say the stock market continues to drop like it has this year and it goes down another 20 or 30%, my net liquidity could drop all the way down to 225. And if these two are the same, then my excess liquidity is zero and I would be in major doo-doo. So I have to make sure that that never happens. And I'm going to go over like how you can make sure that you don't get into a position where you're forced to liquidate your positions. Now, Interactive Broker doesn't actually call you like with a traditional margin call. They just give you a warning when you are close, like when your excess liquidity drops to within 10% of getting your positions liquidated. And if the excess liquidity gets to zero, then they just start selling your positions. I'm not exactly sure which order they sell your holdings in, but I've actually had it done to me once before, and it was just my latest stock that I bought. So it might be just from the most recent trades that you made, it just starts liquidating those. So there's lots of reasons why your excess liquidity could go down, but the most common one is because the stocks you own are going down. So again, excess liquidity is just the difference between the net liquidity and the maintenance, because the net liquidity is how much money you actually have, and the maintenance is how much you need to have, right? Because you always need to have more than what is the bare minimum that's necessary in order for your margin account to continue operating. So let's go over a quick example to see how it works. Let's say you have $100 worth of shares, and if IB can lend you 70%, then what that means is you have to put up at least $30, and then the brokerage will lend you up to $70 so that you can use this money to go and buy your $100 worth of stock. Now, let's say you did that, but the stock drops to $90. Well, what happens now is the amount of money IB can lend you is not $70 anymore. It's actually less, right? Because the stock is not worth as much as it used to. So if your investment is now $90 and IB can lend you 70% of this, then times 0.7, that means they can lend you $63. But the problem is they've lent you $70 before. So now they need to ask for some money back. And the difference between what they could lend you before to what they can lend you now, which is the difference between 70 and 63 or $7, is how much you need to put into your account in order to not get liquidated, because you essentially have to pay them back to cover the extra risk because now the stock is lower, right? So you have to put up at least $37. They put up 63, so the total will still equal $100, which is what you initially paid for the investment. So when people get margin called, it's because they bought something very highly leveraged. Let's say they only had like $33 in their account and their investment drops to $90. Well, $33 isn't enough because you need to have 37. So what IB does is it just sells the stock and you basically sold it at a loss, because IB cannot be on the hook for if the stock loses money, right? Because let's say if the stock continues to go down all the way to zero, well, if they continue to have lent you $70, then you've only lost, what, $30? So they don't want to take that risk, which is why if the stock is going lower, they have to reduce their risk by making you pay them back so that they're not left holding the bag at the end, which makes sense. Now, obviously, if the stock price goes up higher and it goes to like $100 $150 or $200, because they've only lent you 70, you don't have to add more money into your account because they haven't lent you more money. They've only lent you 70. The stock is worth a lot more now. So the amount that they've lent you is less than that 70% threshold. So they don't have to do anything. This is why it's generally a good idea to have more money in your account than just the bare minimum initial margin requirement. So for example, if you had like $50 in here, then even though IB could lend you a maximum of $70 because your investment is $100, they're only going to lend you $50 at this point because you already have $50 of your own money. So that kind of gives you some wiggle room. Even if the stock drops to $90, nothing changes because the amount you hold is still $100. So 50 is what you put up and you still owe the brokerage $50, right? Because even though the stock has gone down, the amount of money they lent you haven't changed because that's based on the initial amount that you bought, which was $100 at that time. Now, if you were to sell by your own decision, because you're not forced to sell at this point, but if you decide to sell when it's at $90, you pay back IB the $50, so they get made whole. And of course, you are left with $40, so you made a $10 loss. In this case, because you only put up $50, it's like a 20% loss because you're using leverage, right? Same thing on the other hand, if it goes up to $110, you get to keep $60, so you made 20% gain or a $10 return after paying back IB the $50. So that's how leverage works in this case. So how do you make sure that you don't use too much leverage? First, you can look what your leverage rate is, and it'll usually appear as a ratio. So in my case, if I log into my account through the web portal under portfolio, if I open up the details here, you can see that my leverage ratio right now is 1.95. So that's about 2. That pretty much means for every dollar that I have invested, about half of that is my money and half of that is debt that I borrowed from Interactive Brokers. Now, the maximum leverage I can get is about 3. So I usually try to keep this between 1.5 and 2. Right now, it's kind of on the higher side of the range that I would like to be at, but that's because the stock market has been going down quite a lot lately. So I will need to be topping up my account by simply adding more money into it. So you can see my security gross position, and I'm borrowing $307,000, which is about half of that. So that's how I get the leverage ratio. If you're just starting out, you can try to keep to a leverage ratio of maybe like 1.2 or 1.3. That way, you can still use leverage, but you're virtually at no chance of getting margin called unless you only have like one penny stock. But if you're diversified or if you just buy the index fund, then using a relatively small leverage ratio of 1.2 or 1.3, you're going to be pretty safe, especially the stock market is already down like 20% from the highs. So it's very unlikely we're going to see another like 50 or 60% drop from here. Now, in terms of how do you add money into your account, what I like to do is to use a home equity line of credit. And this alludes back to what I was saying earlier, that if you have a home or some other kind of fixed asset or collateral that you can use to borrow against with relatively low interest rates, then that's going to be really helpful. So I have a couple of different HELOCs that I can use, but they all pretty much work the same way. They're sort of like a floating rate loan that you can use, but you also don't have to use. So the starting balance when you open one up is 0, but when you borrow money from it, then you accumulate debt. So if you own a property, you can talk to your mortgage broker or your lending specialist at the bank to see if you can open up a home equity line of credit or HELOC. Sometimes there's a fee associated with it, but otherwise it shouldn't cost you anything unless you start to borrow money from it. It's kind of like a margin account. If you just throw like $100 into a margin account and you buy $100 worth of stocks, you're not going to get charged any interest because you're not technically using margin unless you start buying more than $100 worth of stocks. So if it seems like your margin account is getting pretty low and your net liquidity is getting pretty close to your maintenance margin, and you're a little bit nervous that your excess liquidity is falling too fast, or maybe you're going on vacation for a couple weeks and you're not going to be looking at your account, if you're concerned at all, just put more money into your margin account using your HELOC, and that way it'll top up your net liquidity again. Basically, like in my case here, for example, if I put in $100,000 into my account, then this 335 will turn into 435, right? And my excess liquidity will go from 112 to 212. So the way that you can make sure you never get a margin call if you're using a HELOC is to just make sure your cash balance is never more than the maximum limit you have on your home equity line of credit. So, for example, if I have a HELOC with a borrowing capacity of $300,000, I don't have to worry about the stock market dropping over the next 2 or 3 years because I can always pull $300,000, basically all of this money out from my HELOC, put it into my Interactive Brokers account. And even if the stock market drops like 85 or 90%, I'm not going to get forced liquidated because I will have enough money to cover all of this debt. I'm basically just transferring debt. Now, the reason I don't want to do that right away and just put money into my IB account to cover this negative cash balance is because the interest rate in my IB account is lower than my HELOC. If for some reason I have another source of borrowing that is cheaper than IB, then I would be using that. Right now, IB's interest rate is fairly low relative to what other places are giving. So for US dollars, if I have negative cash account, I'm paying 5.83%, and for Canadian dollars, it's 5.65%. This used to be a lot lower, but right now, because interest rates have gone up like 4% over the last year, I've seen my margin interest rate pretty much triple over the last year. But I think next year we're going to see lower interest rates. And also, even though this is fairly high if you compare to the last decade or so, the stocks are also relatively cheap compared to the last decade or so. So the cheaper the valuation of stocks are today, the higher chance that they will give better than average returns in the future, which is why I'm comfortable holding debt even at these levels. And I think my HELOC is around 6 or a little bit over 6%. So that's a little bit higher than what I'm paying with Interactive Brokers. Now, there is something additional you can do if you're doing dollar cost averaging, for example, and you want to take advantage of more leverage to put into the market without worrying about running out of money in your HELOC. You can basically set up some kind of system where if the S&P 500 drops, then you can put more money from your HELOC into your margin account over time. And that way you can sort of buy the dip as the market is going down. And of course, when it recovers, you're in a better position to take advantage of all those gains. So for example, the S&P 500, let's say it's 3,800 today. It's 3,852 actually, but just to make it simple, let's say it's at 3,800. And you can say for every 300 points, the stock market drops, you're going to transfer some money from your HELOC to your margin account. So right now, your HELOC, you just open it up, you have a maximum borrowing capacity of, let's say, $100,000. Your margin account, let's say the net liquidity is $100,000 right now. So if the stock market drops to, let's say, 3,500, it's a $300 decrease, what you can do is borrow, let's say, $25,000 and move that from your HELOC into your margin account. So that's going to be added over here. Now your account won't be 125,000 because most likely your account value will likely be less because the market has fallen. And let's say the market goes down another 300 points. Well, maybe now you'll want to bring over $20,000 and you add that to your margin account. And this can continue until you get to like $5,000. And then let me see what the total of this is. Just sum that up. It's 75. Okay, so you still have another $25,000 of borrowing room inside your HELOC. So maybe at this point, for every $300 the S&P 500 goes down, you just continue to borrow $5,000, and you do that like a few more times. At some point, the S&P 500 is going to stop falling, most likely around 3,200, I think. But worst case, it might drop to like 2,000. But you're still going to have enough money in your margin account to cover that all the way down to 1,100. If the S&P goes down that low, which it probably won't, right? So over time, if the market drops to, let's say, even 2,000, then you've already put in all of this money into your account so that if it bounces back up to, let's say, 4,000, which isn't even the highest point of the market, then you've basically just doubled the $5,000 that you put in down here and a little bit less than doubled the 5,000 you put in here. But basically, the more money you put in as the market is going down, the more money you can make as the market recovers. And the reason why you put more money into the market earlier is because it's a lot more likely for the S&P 500 to drop from 3,800 to 3,500 than say down here to drop from 2,300 to 2,000, because those scenarios are not very likely. And then the idea is when the market eventually goes back up, you can sell some of your stocks and repay your HELOC. You're making a profit because you're borrowing money and transferring it into your brokerage account when you are buying the stocks when they are low, and then you are selling them when the stock market is higher. So even after you repay back the HELOC, assuming the return you get is more than the interest you paid, then you should be making a gain overall. So hopefully that makes sense. I basically have a HELOC that I use to fund my margin account if I need excess liquidity, and that way I don't run into any problems with not having enough capital inside my margin account. And even though the market has been pretty bad this year, I think next year, especially starting from maybe the second quarter, we are going to see the beginning of the next bull market. And I think using dollar cost averaging from now until then, like over the next 4 or 5 months, will be very beneficial for anyone who's staying in the market for the next 2 to 3 years. Now, technically, a home equity line of credit is a callable debt. So at any time, supposedly, the banks could say like, hey, you have to pay like all this money back. I've never seen it happen before, so most likely it's not going to for the foreseeable future, but that is something to be aware of, which adds another dimension of risk onto this. So anytime when you're borrowing money, there are multiple things you have to consider, but as always, do your own research, and I wish you all the best with your own investments. Thanks a lot for watching, and I'll talk to you in the next one.